From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Hello, it's Friday, June 14th, 2019. You're listening to Hamilton Place Strategies Macrocast, along with our friends from Markets Policy Partners. Every Friday, we take a look at the major economic policy and data stories of the week. I'm Tony Fratto, founding partner at HPS. You can check us out at www.hamiltonps.com. We also tweet at HPS Insight, and I tweet at Tony Fratto. I got to know John Fagan during his time running the markets room at the U.S. Treasury Department, and Brendan Walsh when he was a senior analyst at Discovery Capital covering global financial institutions. Today, John and Brendan run Markets Policy Partners, where they provide independent financial market analysis for public sector audiences, among others. You can find them at www.marketspolicy.com. So, guys, we're back here a week ago. We all thought that the 5% Mexican tariffs were going to go into place. What President Trump was threatening if there wasn't sufficient action on the border. We all predicted. I think we were all in that boat together. We were all wrong. Rescued at the last minute by, I don't know, maybe what was a deal that actually Kirstjen Nielsen had negotiated months ago is the deal that they got for threatening the 5% tariffs. But there they are. The tariffs did not go into effect, and disaster was averted.
And we saw with the equity markets rallying into Friday last week, we had a 5-day rally going with just leading into that decision. The equity markets seemed to really sniff it out, and we went over 3. But that's okay. And certainly we can see how this rather abrupt resolution to this U.S.-Mexico tariff and border issue makes it even harder for investors to picture something not working out between the U.S. and China on their trade negotiations.
So that bias leads them to think that there will be a solution in the offing.
Right. It feeds into the confirmation bias that a lot of investors have had, which is the operative assumption is that the U.S. and China, the stakes are simply too high, and they do eventually find a deal. And looking at this, the way that this concluded, it certainly tees up investors to think, more positively than they already do, perhaps about how things are going to go down at the Osaka G20 on June 28th, 29th. We've heard some commentary this week that the preparations for the Trump-Xi summit have been minimal to this point. Mm-hmm. President Trump was in an interview this morning said that it maybe doesn't even matter if President Xi does turn up, but the expectation is that post this summit, talks will be restarted, and or at least there'll be a ceasefire in tariffs. An increase, if there really isn't a meeting and there's no progress and tariffs do go up, then I think that would be quite a shock, and markets aren't priced for that. I think certainly equity markets aren't braced for that kind of outcome.
Well, let's put for the moment, because this is actually, so that was last week's news. We don't actually have trade news this week, so we can put it in its box for at least one more week. Let's get back to something that we have been paying attention to, which is the Fed and rate expectations at the Fed. We talked about the rally in Treasuries last week and the rising market-based expectations for Fed rate cuts. Rates have backed up only slightly since then, and the rate cut odds are even higher than they were a week ago. We've talked about this a little bit, but I mean, is the Fed backed into a corner here on this?
Not entirely, I think, is the short answer. The avenues of escape maybe are narrowing, and time isn't necessarily on their side when we look at the way that markets are positioned for the coming rate decisions. So next week's meeting, which the decision comes down on Wednesday midday, 2 p.m., followed by the Powell presser at 2:30. The rate cut odds implied by futures markets right now are about 1 in 5. So the Fed isn't the market isn't
for June.
Yeah. So for next week's meeting, the markets aren't really expecting it. They wouldn't be surprised if the Fed does come out with a cut, but 1 in 5 odds. That doesn't suggest disappointment if the Fed stays put. The story changes, however, when you look out at the July odds. The July meeting odds are 85%.
Yeah.
That is, it's not. It's
not 100%.
It's not 100%.
But there will be significant disappointment if they don't see a rate cut in July.
And given the fact that this huge jump from basically 20% to 85%, that suggests that market participants may not be disappointed if the Fed doesn't cut rates next week, but they would definitely register some surprise if the Fed doesn't make a strong case, signal, and guide.
Does this seem weird to you, though? By the way, though, like this sense that so unlikely a rate cut in June, but almost slam dunk rate cut in July. I don't know that I've ever seen a month-to-month spread like that, because if you can anticipate that the conditions would warrant a rate cut in July, well, you say, well, why not just do it now, right? And that way you won't have you can take care of the conditions that might exist potentially in the future. It's weird that we have that kind of spread in expectations. I think I haven't looked at it historically, but it seems like just weird.
There is definitely some of that is keyed off of the Fed's communications, where they've edged toward the market with the new abandoning patience, which was the neutral formulation, that mantra that they repeated, that Fed Chair Powell and so many of the others repeated again and again: patience. And that was really only lasted for a couple of months. And the recent last week, we heard that formulation basically abandoned in favor of act as appropriate is the new stance.
Right.
And so that act as appropriate if necessary, that's a relatively qualified kind of.
I don't know what that means. What that means is, like, we'll tell you later when we've sorted things out a little bit more.
Right, and the market is basically saying, okay, that means July.
I met with a very well-connected Fed watcher this week, friend of mine. He was out in Chicago for the communications meeting in Chicago last week or 2 weeks ago, I guess now, and and he had lots of conversations with. We were laughing about this. He had lots of conversations with FOMC members and others at the Fed, and there was some complaint about some of the market expectations, and his reaction was, "You understand they're just listening to you, right? I mean, if you're concerned that they're about their how they're have this weird sense on expectations, it's because you're giving them that. I mean, you guys are really, really hard to interpret right now, and so his advice to them was, you should go back and talk amongst yourselves a little bit and think about what you're really trying to convey. So I actually think, like, the communications, as you alluded to earlier, communications on the June meeting. I mean, Powell's job. He's going to have to stick the landing on this. Whatever it is, in fact, that they're trying to say, he better nail it, because he's losing credibility if he doesn't signal better. If it's his intention to signal better, he better do it better and not come out complaining about people aren't understanding us.
Right, and certainly if he does make the case and guides more forcefully for a July rate cut, as the market is basically expecting, that will probably be based on their concerns about downside inflation. That's really been the laser-like focus for the doves on the committee, about trying to shore up downside risks to inflation expectations. We're seeing market-based gauges of inflation, 10-year break-evens, 5-year break-evens. These are not going in the right direction. They're at the lows of the year and continuing to drop. Now, that's the actual inflation data that we've seen this week. I think Brendan is in New York, but he's going to join us and talk a little bit about some of the inflation data that we saw this week, which was a little on the soggy side. But today, we had we had some other data points which certainly argue potentially, would be seen to argue against a near-term rate cut. So, Brendan, maybe you could walk us through those.
Brendan, before you start, let's take a quick break. When we come back, we're going to talk about inflation and today's retail sales and industrial production data. You're listening to the Macrocast. You're listening to the Macrocast. Brendan, what do we see from the inflation data?
So we had the CPI come in this week, and it was definitely a disappointment. The core is under 2% now, and when you kind of extrapolate that to the core PCE, it looks like we're going to be at a mere 1.5%. So on the inflation side, the Fed definitely has room to cut. But today we got retail sales, which came in incredibly strong. And more importantly, the kind of soggy first quarter was revised higher. So what I think happened there was the tax cuts kind of had a year rollover, and we had a bit of a rebasing. But it's kind of clear that the consumer is doing quite well. Basically, retail sales are running about 6% annualized rate. So it's a bit of a dichotomy where you have weak inflation, you have definitely weak manufacturing, which should be expected because we're in a trade war. But kind of the rest of the service economy and employment are doing quite well. And the other problem that the Fed has, it basically goes back to credibility, but the president has thrown in a large monkey wrench into. So yesterday he did a interview with ABC that's going to come out today where he vehemently criticizes Chairman Powell, says he's ruined the economy and he needs to cut immediately. As someone who grew up in Massachusetts and is of Irish descent, I might be a little more obstinate than the average population, but I know that I would definitely not cut if someone told me to do it.
Yeah. Yeah, I mean, there's no question that that Powell is in a tough place. I mean, you get the sense they feel like they want to cut. They also understand that if they were to cut, and do a June cut, I think the market participants would interpret that as Powell being bullied into an earlier cut than they had intended. And so the ability to have the Fed come out of this episode, this period of readjusting where they want rates to be given their outlook on output and inflation, and to come out of it with credibility is becoming, by the day, a much more difficult trick for them. They may get it right in the end, but getting it right with a sense of independence and credibility at the Fed is, I think, maybe the harder trick. And I think they're going to have and Brendan, I'd actually be curious to hear what you're hearing up in New York. I mean, do market participants think the Fed is being bullied by the White House, or do they think it's an independent Fed? And I should say, I think it still is. I mean, I think they are trying to do the right. They are trying to interpret data and do it. But do market participants see it that way?
I think they're questioning, not necessarily the Fed in it, but I think people up here definitely think that the president has influenced the Fed into being more dovish than they generally were, which is troubling.
Market participants also focus on how market price action. They believe that market price action can be deterministic for the Fed. Mm-hmm. And basically, if you get futures implied odds of a rate cut and expectations so built up, it's very hard for the Fed not to deliver. Now, that's sort of maybe it's self-serving Wall Street thinking, but that comes out in a lot of commentary from analysts. Yeah,
and the conversations I've had now, people, while they still expect a cut in July, people are getting more nervous that the Fed is going to disappoint, and you could have a large sell-off in equities and potentially very large move up in rates.
Well, certainly what could bail them out is if the G20 comes and goes without any sort of restart in the U.S.-China negotiations for trade and tariffs go up, well, then you would see likely a very a very adverse financial market reaction, and that would that would give the Fed all of the justification it would need, presumably, in the July meeting to get going on rate cuts.
Right. I think that's right, and So we'll. I mean, we're gonna see what happens.
Yeah, and one thing is, the markets are not just predicting a one-off. Certain Fed speakers have suggested the concept of an insurance cut will give you one, and maybe to try to protect our downside and inflationary expectations and so forth. But in most cases, rate cuts are like potato chips. You can't have just one. I know I can't have just one. Potato chip.
Yeah, and also the market is a bit misplaced. Basically, every time the Fed cuts, we go into recession and the market sells off. So you could get a short-term bounce, but it's not a good. It's historically a very, very bad sign for future returns.
Yeah, it's right. It's such a great point, Brent. I mean, we're going to want to take a break here in a minute, but that point, maybe we'll get into it next week a little bit too, is and look back at some of the history on that also, because right when the Fed is thinking about putting in place a rate cut, they are signaling to the world that they think the economy is soft, right? And you can say they're worried about hitting their inflation targets, but what they're really saying is that we're concerned about future growth, so we're going to give you a rate cut. Well, that's the Fed's disappointment in the inability to meet their output target is not a good sign. That's a bad sign. So you should expect over time a mixed reaction from the markets.
I think that's absolutely correct. There's just one thing I would say, which is in the modern in this post-crisis era, in the old days, rate cuts were they were an end to themselves. You would cut rates until rates were low enough. At this point, with the range topping out at 2.5%. Any sort of recessionary in the past, rate cuts would go into the 450 basically 400 plus basis points of rate cuts to balance out recessionary downside in the economy. They don't have that kind of headroom. And so now in this new era of central banking, the pot of gold at the end of the rate cut cycle is QE. And QE is a great enticement to upside equities. So to draw equities higher, at least in the minds of a lot of market participants. So that may change the dynamic this time.
Yeah, definitely. So let's take a quick break. You're listening to the Macrocast. When we come back, we're going to talk a little bit about oil. We had some oil events this week. Okay, and we're back. On the Macrocast, guys, we had woke up to an event in the Strait of Hormuz yesterday. Some attack on Japanese tanker. By the way, while Prime Minister Abe was visiting the country, it was a very strange event in the region. Oil prices reacted. What do we make of this?
It was a fascinating reaction in oil markets. We've seen, just to set the scene, Brent crude and the U.S. benchmark WTI have been in a very steep downtrend since the end of April. Brent, which is the international benchmark, was trading around $75 a barrel at the end of April, and it proceeded to head downward in May along with global risk assets, but never really recovered, even as the S&P 500 and a lot of other risk assets got a bounce here in June. Oil prices remained very, very downbeat. We saw some volatility in implied volatility in oil markets is basically back at the highs of the year, and not as violent as it was in December, sort of early January period last year, but something like 14 of the last 20 days have featured moves of greater than 1% in oil prices, mostly to the downside. So that's some pretty some pretty chunky moves. And so Brent is really it's trading around $61 a barrel. That's at close to the lows of the year. Understandably we got a big bounce in oil prices when the news broke yesterday morning about these tanker attacks. But looking at the price action through the day, they prices shot up reflexively over 4% and then settled down. And they just kept bleeding lower, and they ended the day only up 2%. That's not that big a move.
No, not at all. So and they just treated it as an event, maybe some potential greater risk, but not as a giant event.
Right. We saw this happen in there was a previous incident, and it was some ships were damaged by mines off the Emirati coast last month, and it really gave oil just a fleeting bounce, and then the fundamentals kicked in, and the bearish fundamentals are back in focus today, even despite the swirling U.S.-Iran tensions and the questions about exactly what happened. They released a video.
Right.
Secretary of State Pompeo blamed Iran. There's obviously crosstalk from all sides on this. But looking at oil prices today, they have failed to go up. They've failed to extend their bounce. A report that just came out in the last day from the International Energy Agency highlighted their downgraded prospects for global oil demand in 2019. They're cutting their demand forecasts to levels last seen in 2011.
Wow!
And while at the same time upping their supply forecasts, and certainly the U.S. shale patch has been producing at a more rapid clip than possibly expected this year. And inventories have been high. These fundamental supply-demand headwinds have been really a major headwind for Brent crude prices, and it's quite remarkable how little the geopolitical risk premium has.
If you're as old as I am, then you remember the 70s and the oil shocks, and even in the 80s with some pretty big swings and geopolitical risk of impacting oil prices. Certainly, the Gulf Wars had an impact, but it's probably the diversification of supply, not just regional diversification with more countries producing oil, which is certainly the case, but also the diversification of energy sources broadly. So a lot more natural gas and even some impact from additional alternative energy. It's oil events don't have the same impact they used to, and from a global macro standpoint, do they?
That's a really good point. Certainly the swing producer that the U.S. has become,
which used to be only Saudi, right? Saudi was really the only swing producer.
It's changed the dynamic enormously. But also, I think you can point to the fact that geopolitical risk premia are really hard to price, and it's hard for analysts to bake that in, and trying to see where in the price a geopolitical risk premium might be built in, or how big one is already. It's art. It's art rather than science. We've also seen geopolitical risks, in some sense, I think, downgraded in terms of their ability to move markets. We certainly see big market moves on the back of policy changes, certainly central bank policy. But when you see a big geopolitical story, it tends to have a very fleeting effect. I think one of the cases when I used to work at a hedge fund, North Korea would say fire off a rocket or have some other provocative action, and the Korean won would sell off against the dollar. We would then buy it because
it's coming back.
You figure, this is a one-off.
It's not going to be World War III,
right? It's not going to be a shooting war here. This is just a provocation, and so it would be a buying opportunity. And now the Korean won, if you watch it on the days when there's a North Korean missile launch or even some really saber rattling from Pyongyang, South Korean assets barely twitch.
Yeah.
And I remember a case where Turkish fighter jet shot down a Russian fighter, and if you'd asked me, the Turkish lira didn't move. It barely moved at all.
Yeah.
And if you'd asked me 5 years ago what it would have done on that, on an event like that, I would have said
that's
it was
down
down 3%.
That's called all the other funds saw your trade, and they right. So
it's geopolitical risk is very tricky to price in, and just in the recent life cycle of the markets, we haven't seen a lasting impact.
Brendan, like this volatility and where oil prices are going, this feeds into Fed thinking, doesn't it?
Yeah, it must, because oil prices lead into gas prices, which are a big factor in headline inflation. So if gas prices come down, so too will inflation.
And we're in the summer driving season.
Exactly.
It's when my experience is when presidents start worrying about gasoline prices more than other times of the year, when people are hopping in the car for the family drive to the beach. It's amazing. I have to say, to me, gasoline. I know that I don't mean this in the sense that the cost of gasoline for people is still a cost. I'm not minimizing it, but it's something like free relative to so many other things, right? I remember, if I see $2.40 a gallon for gas, well, I remember $2.40 a gallon for gas 20 years ago, right? Right? It seems like we've been around the same price for gas. It's gone up in the fours for a gallon. It's been in the low twos. But prices of all things have gone up, but gasoline seems to settle in a place that's like, again, I say this because the price hasn't risen all that much overall at the pump. It's something like free that way, and our gasoline efficiency in cars has gone up too.
Yeah.
That is in 2014, 2015, when oil prices really sank. It was a huge bear market in oil, and economists were waiting for that to show up in U.S. consumption. Mm-hmm. They thought, spending in restaurants and other places, retail sales, gasoline would go up, and it just didn't happen that way.
Yeah.
And I think it's one of the other dynamics is that when economists look at high oil prices, from a market perspective, high oil prices are coincide with rising market-based gauges of inflation expectations.
Right.
10-year break-evens go up with it. Inflation swaps track oil. From the economist perspective, that's crazy. High oil prices are deflationary,
right? Yeah.
And I think that's a real that's a source of disagreement between the financial markets.
Yeah, I think it holds a special place, right, because of our history with oil, with gasoline prices, and it is, of all of the prices in our world, our life as consumers, it's the thing we see advertised on the street every day. We will see, right, just like driving home on the commute from work, 8 different retailers advertising their price of this product that we have to buy. And so we use it as a gauge of how things are going. If prices are really high, we think, wow, that's not really good. That's not great. Things must suck if, gas prices are really high. And but it's the most, if the price we're most aware, no one asks presidential candidates, hey, what's the price of gasoline, right? Because everybody knows the price of gasoline. We see it in the in our commutes every single day. So it's so it holds that special. But the other thing is the markets. What are equity markets doing? Because we see a green arrow, a red arrow, anytime we look at a television. And so if the market's up, people generally know if the market's up or if the market's been broadly down. And so that's your gauge on how the market is doing.
Yeah, I think that's true. And it's just to build on what you said about the markets, people focus on the equity markets, obviously, 401k culture here in the U.S. and that sort of thing. And it's, as we've highlighted before, this year we've seen equities and bonds kind of in different worlds. And if investors were really focused on the message from the treasury markets, they may not be quite as upbeat, but certainly looking at the equity markets, we're only less than 2% off, only 2% off all-time highs,
exactly.
even after a pretty choppy May.
All right, gentlemen, I think we're going to call this week's Macrocast a wrap. We've been trying for a couple weeks now to talk about Italy and Europe. I'm actually going to be in Europe the next couple weeks. I'll be coming to you from Brussels next week. We'll be recording the show with me from Brussels. So I promise in fact we may actually, barring some unexpected crazy event, we may actually even lead with Italy. Italian credit.
I love it.
Italian credit may lead the show next week. We'll see how that goes.
Looking forward to that.
All right. For John Fagan and Brendan Walsh, I'm Tony Prado. Thanks for tuning in to the Macrocast. Enjoy your weekend. We'll be back with you next Friday.
Thanks for listening to the HPS Macrocast, produced by Hamilton Place Strategies in association with Markets Policy Partners. For more from Hamilton Place Strategies, follow us on Twitter at HPS Insight. For more from Markets Policy Partners, please visit marketspolicy.com.